If you've been watching the markets in early 2025, you know that we're living through some seriously turbulent times. The first quarter has been a roller coaster, with the S&P 500 posting its worst monthly performance since September 2024, while the Nasdaq has officially entered correction territory, down more than 10% from its January peak. And let's be honest, it's been a really wild ride. In early March 2025, we watched the Dow plummet over 400 points as investors tried to make sense of President Trump's constantly shifting trade and tariff policies. The markets have been attempting modest recoveries amid continued uncertainty, but volatility remains elevated. I've navigated through multiple market cycles over my almost 2-decade-long career, but 2025's volatility has a different character altogether. It's not just about normal market fluctuations. We're seeing the direct impact of deglobalization playing out in real time. Before we dive in, let's do a quick refresher. Volatility in finance is fundamentally a statistical measure of price dispersion, how much an asset's price deviates from its average over time. In simpler terms, volatility is the range of price change a security experiences over time. Low volatility means relatively stable prices, while high volatility indicates rapid highs and lows, erratic movements, and dramatic price swings. And there are a number of ways in which you can get a sense of how volatile a market or individual security is. Let's get back to what's actually happening in the world right now. The volatility we're experiencing isn't random. It's being driven by specific factors that are fundamentally reshaping the markets today. President Donald Trump's implementation of tariffs on Canada and Mexico in March 2025 sent shock waves through global equity markets. While some tariffs were postponed till April, the uncertainty remains. Add to this the new 20% tariffs on Chinese imports announced in February 2025, and China responding with saying that they are ready for any kind of war, and you can see why the markets are on edge. This is creating more than just a temporary blip. It's a structural shift that's likely to persist beyond 2025. I remember sitting with an investor friend in early February 2025 who was convinced that these tariffs would only affect certain sectors. My tech stocks should be fine, he insisted. Truth be told, I did not disagree with him. And just weeks later, that same person called me as Nvidia had dropped another 5%, continuing its significant decline in 2025 along with the rest of the Mag 7. Now, part of it is definitely because the AI trade is in flux after DeepSeek made a splash and Alibaba followed suit, but we cannot rule out the fact that tariff uncertainty is part of the equation as well. This is exactly the reason why understanding the interconnected nature of today's markets is so very crucial. Now, there are predictable ways in which people freak out and tend to respond to volatility. When markets get choppy, I see investors make 3 critical mistakes that absolutely destroy wealth. First, they confuse volatility with risk. Like we just discussed, volatility is simply price dispersion, how much an asset's price moves from its average. Risk, on the other hand, is the potential for an investment to lose its value. It comes in 2 flavors, market and firm specific, and we'll leave the details of risk for another episode. But just know that volatility and risk are not the same. Second, they make emotional decisions during market swings. During the March 2025 sell-off, trading volume spiked as panic selling took hold. By the following week, some of those same investors were trying to buy back in at higher prices. Third, they focus on short-term noise instead of long-term fundamentals. Remember, investor sentiment drives short-term fluctuations far more than actual business changes. So what do you do when markets are behaving the way they are? The best path forward is to take a more intentional and deliberate approach. If you like to do individual stock picks, do you really know the companies you are invested in currently? If not, this is a good time. And while you're doing that, put it through another lens. Is your portfolio ready to work for you in a world where deglobalization may become a fast emerging and dominant theme? This is exactly why I developed a relatively simple diagnostic assessment called the Deglobal framework. to help evaluate an individual portfolio's resilience during periods just like this. Watch my full video on the impact of deglobalization on investment portfolios here. You can download the questionnaire and the insights key from my website. The more globalized the world economy is, the tighter the world markets are intertwined, meaning there is a higher correlation between market movements. Deglobalization does just the opposite. It reduces correlations. And the reduced correlations between markets during deglobalization actually increase the benefits of diversifying globally. While many investors are retreating to their home markets out of fear, our line of reasoning would suggest that at least some amount of geographical diversification is actually beneficial to your portfolio. So what specific actions can you take today to navigate this volatility? Here are 4 practical strategies for you to consider. First, implement or maintain the time-tested strategy that balances growth with stability. Allocate a portion of your portfolio to high-growth sectors while balancing with stable income-generating assets. This approach has proven itself effective, whether during normal times or during previous periods of trade-related volatility. Second, maintain strategic liquidity. Keep 10 to 20% of your available capital in liquid funds to seize opportunities during market corrections. With the S&P 500 dropping below its 200-day moving average in March 2025, a technical indicator that has historically preceded further volatility, having dry powder ready is crucial in case buying opportunities emerge. Third, consider short-term treasury ETFs. As tariffs potentially create inflationary pressures, these instruments can provide stability while maintaining liquidity. As with ETFs, they can be purchased through your existing brokerage account, and MERs on even the good ones are quite low. Fourth, if your portfolio is primarily US focused, now is a good time to at least take a look towards Europe and Asia. As of March 2025, the MSCI Europe Index is trading at a 40% valuation discount to the S&P 500, which is double the long-term average. Finally, our oldest friend in the playbook, use dollar cost averaging for all new positions. By investing fixed amounts regularly, you'll average out your investment costs and avoid the psychological impact of trying to time these really volatile markets. At the end of the day, market volatility is an inevitable part of investing, especially in a deglobalizing world. But with the right framework and strategies, you can potentially turn this volatility into opportunity. Don't forget to check out the Deglobal assessment to see where your portfolio stands. If you found this useful, like this video, hit the subscribe button, share it with someone who will find it helpful as well. Let me know how you are navigating volatility in this Trump era. I'll see you on the next one and have a great day.